In chapter 17, we took a look at the Greek letters, which are the risk parameters for call or put option value with respect to underlying asset, exercise price, sigma, and also the other one is time to maturity, the time decay situation. So most financial institutions, because their portfolio contain those derivative securities, like options, they underwrite certain options. So it's more complex. So if the portfolio is very large, they need to measure those parameters like a delta, almost daily. To monitor all aspects of the risk because the price is constantly changing. So those risk parameters, like the delta, gamma, and the vega risk, are kind of detailed from a particular aspect to for one parameter. Now, from top of management, they probably do not want to see the detailed, the risk exposure or what the hedging they are taking. They rather want to have some kind of report, summarize everything into one thing, one parameter. That is how the value at risk came from. Value at risk is also called VaR. I'm just call it VAR. VAR. It's right, the capital letter V, lowercase a, capital letter R. Do not write like all capital letters, which VAR, VAR, usually commonly people use as a variance, using variance. But if you write it in the capital letter V, lowercase a, and R, we know this is how the value at risk usually used. Okay. Sometimes people call it VAR. I really don't like that word. Chapter 12 basically also added more material to it because the time limitation. Let's just concentrate it on the value at risk and do some basic calculation of value at risk, which give you a foundation for future study in financial risk management technique. So instead of looking at the detailed, like those delta risk, gamma risk, the top level management want have one question. It said, what is the possible loss that we are, let's say, 95% confident for the next 10 business days will not exceed that particular value? So worst case scenario, what is that value? Now, this one, let me just give you one example to see what that means. I'm not going to using the text example. I'll give you other examples, which, assuming that you have a intermediate bond portfolio, the total value is 100 million. The value at the risk might ask, what the possible, the maximum loss you will lose in 1 month? What the maximum loss you might have? How do I do that? How do I answer those questions? But obviously, we need a probability, isn't it? You find the finance we are dealing with the future event for uncertainty. A academic way to do it or a scientific way to do it is using probability. Now, where come those probability? Usually, people using historic rate of return. The reason I'm using the bond portfolio instead of stock portfolio, because the bond portfolio have what we call the mean reverting process. The interest rate cannot be extremely high because that will causing recession. On the other hand, if interest rate constantly very low, like we are experiencing now, you might causing, in most situations, you might causing like inflation period. So it's to a certain point, we're going down, revert to long-term mean. So I'm using bond portfolio as an example. Let's calculate its value at risk. And we're looking at is the past performance, monthly return. And using that past performance, let's distribute, let's plot a histogram for a distribution. If we're looking, if it's normal distribution, let's look at what is the 5% based on history. You will lose. 5% will lose. So we are assuming the 95% confidence interval. So the whole curve under standard normal distribution is 100%. We are looking only 5% loss. Looking at that possibility. Okay. So here is the real case of monthly return for how many observations? I forgot. 56 observations. So many years. So you'll see that they have up, they have downs. As I said, that bond portfolio is the yield to bond will be going up, going down, going. You cannot constantly like a stock market going forever because unlimited liability. Bond behavior is more of a the volatility is much less volatile than stock. So let's assuming going up, going down, going up, going down. For that period, they must have business cycle a couple of times. Okay? Those are true history monthly return per month. Then we're using histogram. I list all those past frequencies, how many occur during 516 monthly observations. Mostly is between around. Most occur in the middle, which is around like a 0.5%. Is monthly, half a percent mostly. But they do have some distribution. But it's look like central limit theory suggests this is kind of a concentrate in the middle around the 0.5%, then tape down, look like a bell-shaped distribution. Assuming this distribution is a continuous, follow a normal distribution, then we basically counted the 5% to the left, not the right, to the left, because at the value at risk, we only concern is the loss, not the gain. We cut off the point. We're looking at the standard normal distribution. We argue that average return is approximately close to 0, so it's a standard normal distribution. So we're looking at, based on this historic distribution, what is the cutting off point? So people also call it the critical value, which give us like a 95% confidence. Now, statistically, 95% here, we are talking about one tail, not the two-tail test. When you study statistics, sometimes two-tail test. Here, we are only concerned is the left tail, because the loss we are concerned. So we said the 5%, we need to do a inverse function. So n to the z, which usually give you the area. For example, let's see that like ND1, ND2, if you still remember. The n to the negative 1.65 give you the area of 0.05. In other words, the left tail from negative infinity up to negative 1.65. This probability is 5% at the 95% confidence interval. Now we can look in that the standard normal table. 1.65 is negative 1.6, then move along to the second digit after decimal point is about 5. So it's 1.65. It's actually not so accurate. It's equal to 0.0495. It's close to 0.05. All right. So that's the number for for the area. Give you so in the middle of the table they tell you the area. Let's look at the middle, the error here, 0.0495. If I round it up to 2 digits after decimal point, it's equal to 0.05. So that's the area. But what is the critical value? Z is negative 1.6 and 5. Negative 1.65. Now you can do this with your spreadsheet. In spreadsheet, there is a function called a norm, standard norm inverse. Standard normal inverse. The following is the two examples. The first on column A, I give the label. For example, we already know we do the norm as this. That is the normal distribution at the parameter negative 1.65. So the B1, give me that number. That number is 0.0495. You can round it up to like a 5%. But on the other hand, I want to go inverse. N prime. In other words, I know the area is 5%. What is the Z? The spreadsheet function, the inverse function, is norm S inverse, INV. The latest one is the norm dot S dot INV. It's accuracy or something, improve accuracy. But the basic idea, that Z at 5%, it gives you a number is negative 1.6449. If those are accurate to 4 digits after decimal point. You can always move, how many accurate you want. 4, commonly 4 or 3, sometimes 2. It depends on how accurate. Usually I do 4-digit decimal point. So in here, the Z value, the critical value is negative 1.6449. So you can do it either using check the table or go inverse with the Excel to find that number. Now here I summarize the commonly used confidence interval. Okay, there are 99%, 95%, 90%. Now, here in the example, I show you the example is 95%, just most commonly used. But here, it is one tail. It's not the two tail. Two tail will be 2.5 to the left, 2.5 to the right. Here is 5% to the left. In this case, the inverse of the 5% is 1 minus confidence level, right? 100% minus 5. What left is the left tail, 5%, is negative 1.65, 1.644 something, right? We are using 95%. Now, using our early example, among all our financial data, 43 years data, okay, with a total sample of 516 monthly return. There are 26 months return below negative 1.65. But here I'm using 1.7. I'd round it up to 1 digit after decimal point. It's whatever you want to do. Negative 1.7, almost equal to negative 1.65. Round it up. Therefore, there's 5% chances at a 95% confidence interval. There's 5% chances you might fall, 1 point below the value of 1.7 million. Because your total portfolio is 100 million. That negative 1.7% represents the possible value at risk. So here I'm using one simple example, bond portfolio, and calculate based on historic probability its possible loss based on historic probability. The value is 1.7 loss. 1.7 loss. Now, the value at risk basically summarized by all those distributions with one number, because this is the top level management will concern. What is our risk exposures? And also, the banking regulators, the financial regulators, they also want using value at risk as a kind of require a bank have limit exposure to risk, and also require the capital based on the banking asset they hold. Usually, the banking requirement, this one I think is old one, that is a European way, is they require you calculate 10 days, 10 business days uh, uh, at a 99% confidence interval, right? So what is the risk exposures, market risk exposure risk is? They want a one number. For credit risk, they are using 99.9. This is almost absolute value, the level, to looking at a 1 year time horizon for that particular asset will be default. So that regulatory commission, they will have like a BISC, BIS. I have requirement. If you have certain exposure, then you need your own money. If you have some asset in options, you cannot use investors, depositors' money to invest in those. So the risk required, the asset capital asset requirement. Value-added risk is the loss level that will not be exceeded within specific probability. Commonly used is 99% confidence. You only allow 1 out of 100, right? The chances, 1 out of 100. What is the worst situation? But people find out it's a cutting off period. Instead of that, more and more people are using what they call, the textbook called expected shortfalls, ES. ES is the expected loss given the loss is greater than the value at risk level. It is also called a conditional value at risk. It's looking at a two-tail situation. So for a 99% confidence interval, you have two-tail, then the level, you're looking at the middle. If you check the figure 20.2, which showed you some kind of the loss part is kind of normal distribution. You check it in the middle, what the expected loss. So the expected shortfall is the mean of the shortfall. Also called expected tail loss or conditional VaR. As I said, because due to the time limitation, I don't want to pile all those too much stuff in this lecture. So let's just limit our study on the VaR. Not the ES. Let's concentrate on the value at risk. The advantage using value at risk are obvious. Number one is a single number. So the CEO know that we have 99% confidence for in the next 10 days. The maximum loss, let's say, is $200 million. Right? Then, can we accept those risks? Right? If you're set a warning sign that our expected loss, for example, if our value at risk, to be exactly, not expected loss, is a value at risk set up at $3 million. To anything higher than that, then we need to make some actions. Reduce our risk, for example, or take more hedging that can reduce your risk. Because a single number, not like a multiple gamma risk, vega risk, is a simple number what the loss is, potential loss is. Although the chances is very slim, 1 out of 100. But it's one number and the people understand what the loss is. So easy to understand. Basically, give you an impression as to how bad can things goes. Right? Let's don't worry about the ES answer. Okay. Uh, just using value at risk. In other words, this is what is uh, the worst case scenario would be. You can, based on that, set up some kind of warning sign at a certain level. You have to reduce your VAR, sell your asset, or take more hedging activities. Now, in practice, many people also do what they call the stress value at risk. Instead of looking at the latest marketing information, which is what we did for the past 43 years, people just looking at the worst case scenario, for example, using the year 2008, that period, as your sample period, because those are Great Recession period. What the worst case scenario, and using that as your distribution to see what value at risk that is. If in other words, if the future next year we can, getting almost like 2008, what is the possible loss we are? Now this is another way to do it, because the key element is the probability and when you get it. Now basically there are two types of things. One is historical, as I just showed you, but they also use the model building. That's the main alternative to the building. You're looking at the multiple regression, actually factor analysis, looking at a lot of factors, come up with a model. All right, using the variance covariance approach. It's very similar to what we did in our portfolio statistics. You calculate the variance and the covariance matrix, looking at the different stocks or different economic factors reaction, come up with a matrix. All right. JP Morgan used to have a risk matrix. They try to build up a standard for everyone, free for everyone. I'm not sure now if it's free or not. It's a model building. They're a model building. But when the daily volatility in risk management, and particularly in value at risk scenario, the volatility sigma are usually daily because VAR require 10 business days. It's unlike like an option where you're looking at annual, right, per annum volatility. Sigma is per year. But in value at risk, we need the volatility or the sigma per day, right? Per day. So what the relationship between sigma per day and the sigma per year? We say the only trading days count. Every year we have 252 days. So the daily, if you know the year sigma, you can divide it by square root of 252. You get a daily rate. Or if you know the daily rate, use daily rate times square root of 252. Now, this is the Brownian motion. You don't forget. Because sigma times square root of t, when we study Black-Scholes model, the basic assumption, right? The longer the period, the more volatile you will occur. It's a geometric Brownian motion here. So in practice, usually we're using the percentage for 1 day, the calculation. The book gives you some example. You're looking exponentially weighted average. No, we are not put too much time on that. We're just looking at using history, the volatility to calculate that. Now let's do one exercise which will help you to understand how value at risk is calculated given whatever the portfolio you have. We're using Microsoft as an example. We have a position worth $10 million in Microsoft share. So when we measure using spreadsheet, we're looking at the volatility daily is 2% per day. 2% per day. If you're looking at annualized, it's 32%, but here's 2% per day. Here we are looking at 252 days, right? Those trading days. We're looking at the business days 10 days later. What is within the 10 days horizon? And our confidence level set up at 99%. So at the 99% confidence interval, what is the value at risk for this 10 million stock portfolio? Now recall, the value at the risk can be calculated. I summarize the mathematical equation here. It's not from the book. I summarized it. Let's look at the equation. First, I put a negative sign in front of it. Means it's loss. Okay? VaR always means loss. Next one is the V. Is the value of your portfolio today times the daily sigma, the volatility, 2% per day, times square root of days. Here the day is 10 days. Microsoft is 10 days. Then times the inverse of standard normal distribution table, 1 minus confidence level. In our example, our confidence level is 99%. 1 minus 99%, that level is 1%. The inverse function for the area of 1%, what is the z value? That z value is negative 2.326. If I run it up to 2 decimal point, 2 digit after decimal point will be negative 2.33. So I'm using the final number, negative 2.326, as the textbook give you this example. 3 digit after decimal point. You just plug everything in. You plug everything in it. Now remember, in my formula, I put a negative sign on it. So when you report your value at risk, you don't say negative 1 million, negative 10 million. You say value at risk 10 million. That means loss. We already know loss, okay? So the negative, take out your loss. Let's do the calculation step by step. So the standard deviation for Microsoft is per day is 2%. 2% times the 1 million. Is 10 million? 1 million, let me see. 10 million. 10 million times 2%. So every day, gain and loss, the volatility is $200,000. Next, we need to time critical value. That critical value for 99 confidence is a loss, right? Negative loss. Let's look at this table. See, negative 2.32. So here the negative, and at the beginning also have negative, positive. So your calculation do not report this negative. Okay, is $200,000 sigma times critical value 2.326 equal to 465,300. Now this is the 1 day 99% value at risk. All right. Now how about 10 days? Okay, using 1 day VaR times square root of 10. Now, Brownian motion is a function of time. Okay, is equal to 1,471,300. That is the 99% 10 days VaR from Microsoft for your 10 million portfolio value at risk. Now the example say, okay, if anything below 2 million, it's okay. If the management say it's okay, because this is based on 99%, I take the risk. All right, you don't do anything. But if your criteria is 1 million, the maximum exposure is 1 million, then the red flag come out because your value at risk is 1.4 or 1.5, right? So you need to sell your stock or buy some hedging, buy a put, for example, from Microsoft to prevent the loss, right? You need to adjust for the risk because value at risk gives you some kind of one parameter to control the risk. Right? It's what the risk exposure are. Okay. Now let's look at another example, which is AT&T. Let's say you have a position of 5 million AT&T stocks. AT&T daily volatility is 1% per day. The 99% interval, or not interval, 99% 1 day value at risk, is the 1% of 1 day, right? Is 5 million times 1%, which is $50,000, then times the critical value 2.326. That's a negative number, negative. Here, negative's gone, so we have 116,300. In other words, 1 day VAR is 116,300. The possible loss. We're only concerned is the loss part. 10 days times square root of 10 days. The amount is 367,800. This is the value at risk 10 days, 99%. For this portfolio is 367,800. The possible loss. Now let's move on. Let's look at portfolio. You have more stocks. Let's assuming your stocks contain two stocks. One is the Microsoft, 10 million. The other one is AT&T. How many million do we have? 5 million. Okay. Now let's assuming the return of AT&T and Microsoft are by very normal. These are multi-normal, still normal distribution. Okay. And their correlation between these two stocks is 0.3%. 0.3 or 30% is positively correlated, but it's not very highly correlated. Only 30% correlated, 70% uncorrelated. Okay. Now, as a portfolio, what is your 99% 10 days value at risk? Now, here, I'm glad you all took my investment class first. That's the portfolio. You have to calculate what is the standard result for the volatility for AT&T plus Microsoft, X plus Y. Now, the volatility of a portfolio is the individual X1, X2 variance plus 2 rho times sigma 1, sigma 2. In other words, it's the portfolio statistic. Take consideration and the correlation. That's the we spend a lot of time on that. All right, Markowitz portfolio. In this case, sigma 1 is 200,000 per day. Sigma 2 or sigma y is 50,000 per day. And the rho equal to 30%. In that case, you plug those numbers in. So the volatility, the daily standard deviation for the portfolio is 220,200. Now, we're using this one to calculate this portfolio 10-day 99% VAR. So daily volatility 220,200 times square root of 10 times the critical value 2.326 using my long equation. Your portfolio has a VAR of 1.6 million, about approximately 1.6 million VAR, value at risk. Now, is that the point is, let's look at what the benefit or the marginal. You put a two stock together in portfolio. What the benefit of diversification? You are using two stocks. Now remember, the individual VAR for 100 million, 10 million, 100 million for Microsoft is 1.471 thousand plus AT&T 367. Now the summation in the first part is the individual VAR for Microsoft and AT&T. Now let minus the portfolio VAR 1620100. The difference is $219,000 difference, or you call it savings. In where VAR of a diversification even reduce the value at risk for the portfolio. Now here just show you this part, but you do need to know the portfolio statistics. It's big because the covariance. The covariance is not 1, it is 30%, not 100%. All right. Now, value at risk is widely used. People sometimes go back to see if those models worked. Can you really predict? Is the history really repeat itself? Sorry. So you will be very often what the result will coming from. Sometimes people looking at it backward to see if it works. If it works, okay, if it works. But usually people find that if you the time for a period, if a cyclical market is cyclical is about 10 years. If we consider current market, we are seems like overdue. Oh, the Great Recessions almost more than 10 years now. So it's a backward testing to see if it works, using 10-year data to see if it works. All right. Now, this is our last lecture. We just covered some basic idea on risk exposure. In the whole derivatives study in derivative securities, we basically I'm providing you a tool to hedge risk, pricing risk, because the derivative security, like a futures market, its basic function, people consider, is price discovery. You can argue some people are speculators, some people are hedgers, but through the marketing mechanic, people can look in the market for guidance what the future value is. So you have a price discovery. For hedger, obviously, they have the tool using futures or options, or even using swaps to hedge their risk. We study that, hedging those risks. Now, basically, derivative security, up to now, we study the basic tools, a basic strategy. How do you hedge the risk using futures, options, etc. But more and more study nowadays, people are looking at credit risk. Another risk is credit risk. So market risk, we know how to measure it and how to hedge it. But how about credit risk? Credit risk, also called a default risk. A good example is people default their mortgage. They give up their mortgage. Or a loan, they cannot pay it back. How do you measure credit risk? Now, a lot of emphasis on that, but we don't have time to really study it. But you have the basic tools to understand the credit risk is. A famous default risk by Merton is looking at N negative D2. The ND2, basically, the assuming, when the asset of a company, future asset, the market value is below its debt obligation, a company will default. In that case, you just measure what the chances based on the option model. And ND2 itself showed you the call will be in the money above the critical value, the debt obligation. So if the value of the company is more than your debt obligation, you pay off the debt, you don't default. You pay off the debt, you get remaining, like a residual value. On the other hand, if the future value of the firm is below the debt obligation, you walk away. You default. Now those are credit risk. Now credit risk is the next subject you might want to study, spend some time on it, and we do have some chapters looking at credit risk on that. Other risk, no, market risk, credit risk are all considered financial risk. Usually, the risk management we are dealing with that. But other kind of corporation type of risk exposure, operational risk, legal risk, or human factor risk. So people are study those risks. First, when you study risk, how to measure it. Then using probability really to price it. This is the only thing. That's why I want to emphasize the week 4. Is that week 4? The week 4, the number crunching problem is so important. Because this is the basic foundation of those financial pricing. You based on probability. Black-Scholes model basically is probability. You study probability and calculate based on the future probability. Same thing is true for credit risk. All right. So in the final, we are going to revisit the number crunching problem again, because that's the key chapter, key lecture notes. We will work on that. You have to work on that and understand how to check the table to the left, to the right, risk exposure. All right. At the very end, I also ended with a couple of infamous disasters. For example, in 2008, AIG, the insurance company, they have credit default swaps. They sell default swaps in their London office. On the other hand, what happened unexpectedly, a lot of sovereign bonds getting default, right? So they are getting into trouble. They're getting almost like sell insurance, but your disaster is more than what they gain. So AIG get into trouble, and government bail them out. Next one is this. It is the also happened in 2008. Lately, they have some kind of a court proceedings on that. It's a French institution, banking for European index future. Now here, I want to mention 3. First one I want to mention is the 1995 Baring case. It's in Singapore. As a matter of fact, in 1994 and 93, I was teaching in Singapore. For that time, it's Golden Gate and the Bank of America, and they have some kind of executive trainings. I met the guy in that Cymex trading. Neeson, I forgot what the guy's name on tip of my tongue. Baring basically is a British bank. They sent like a 2-person operation in Singapore, selling Nikkei 225 futures contract, just betting on that. Baring is basically taking like a 95% of total share. In other words, it's a dominant. So they can manipulate this guy, Nick Leeson. Yeah, now I remember his face. Nick Leeson basically can control the market by when if the Nikkei 225 futures goes up, he can dump to the market. Now those are traded on Singapore Cymex because he can corner the market because the holding is so big. He can manipulate the market price. So so he basically selling call, selling puts, totally naked, naked position. But he can move the stock. That's within that port. One time in 1995, um, when the market went down, Nikkei 225 down, he's starting to purchase, to buy instead of a dump. He want to push the stock price, stock index traded on Cymex going up, and he take a long position. All people dump to him. Then Baring took it, since it's only margin call. It's a margin, so he have plenty of capital to do it. He did this for 5 years. For the past 5 years, their operation make most of the lion's share for Baring Bank for revenue. So he is the employee of the year or something. But in 1995, what happens is Kobe earthquake. Kobe earthquake. When he took a large position in long position, the market crashed. He does not have enough money come out, so he default. He escaped, as a matter of fact. Then declared bankrupt. The Baring basically declared bankruptcy. There is a BBC, I think, BBC television series, Rugged Trader or something, describe that things. They are usually saying, we don't know what he's doing. The other thing happened is the Orange County investment pool by Robert Citron. The guy took a lot position, try to enhance their their municipal bond pool, the working capital put in municipal, in order to increase the investment return. He get into the business of interest rate derivative security. He take a short position at the advice of Merrill Lynch investment advisors. In 1994, when interest rate changed, they're getting into trouble. They have to declare default. And Robert Citron is actually put into jail, I think. His claim basically, I was duped by those, financial advisor. They usually will say that, no, I don't know. I don't know what I'm getting into. Those usually claim they don't understand. But anyway. But the last one, I really want you to take a look, is the long-term capital management, LTCM, the disaster in 1998. Why this is so interesting is because the key personnel are Merton and the Schultz. Now, Fisher Black already dead that time. And on that year, I think in 1997, they received Nobel Prize winner economics for the Black-Scholes model, Black-Scholes-Merton model. He basically they seems to know how to suck up all those inefficiency using portfolio and perfectly hedge. They are hedge fund betting on the interest rate and foreign currency in Russian currency, ruble. They supposed to is the expert, the top expert, but they didn't really as academics they are not really they engaged in some speculative position and get into trouble. And because the position is so big, any bankruptcy will causing big trouble. So the Treasury Department will summon all those financial Wall Street firms to bail them out. They bail them out. So actually bail them out. There's one firm refused to do that. That firm refused cooperation. Berenstone is the one that really getting into trouble in 2008. Right? Didn't play, the team player. They are not considered playing player. There's kind of political movement in bailing out a long-term capital management. That's the irony. Because the key personnel are the founder, we'll call it the founder of Black-Scholes model, Black-Scholes murder model, themselves will get into trouble. So this is why derivative security sometimes, because it's leverage, nature of leverage, will causing many people are thinking it's too dangerous. It's too dangerous. It might causing a lot of a risk. When the market crash, it become, we're causing a lot of loss. So this is as a beginning of a financial risk management course. Within 7 weeks, I'm just cover as much as I can in the online case. It's really unprecedented, for me at least. But I want to end it with this lecture with a following things. It's a make it lighthearted. Here, let me give you the 10 reasons why the Titanic was actually a derivative. Yes, I'm using the fashion of David Letterman's countdown. Number 10, the downside was not immediately apparent. So if you own stock, if you own options, call or put, or futures, it seems, not that dangerous. Number 9, it was underwater within days of its launching, despite the salesman's assurance that it was unsinkable. The Titanic's unsinkable. Number 8. The structure appeared ironclad, but fell apart when it first hit trouble. Number 7. Nobody really understood the risk. Number 6. Nobody spent any time monitoring the risk. Number 5. The disaster happened overnight, London time. Number 4. Only a few people got out in time. Number 3. People subsequently spent a large amount of money trying to salvage something from the disaster. Number 2. The only people who made money out of it had no connection with the original transaction. Drum roll. The number 1 reason why the Titanic was actually a derivative is, despite the disaster again, people continued to participate in similar venture. Okay, let me end this lecture in the positive notes on this risk management. Next week, we will have no lectures. Give you plenty of time to do a review. If you have any question, please email me. I'll try to answer as soon as possible. And worked on my lecture notes. It's kind of, do not print out those notes if you're hidden it. You're not responsible for those. Okay, good luck for your working on the homework assignment. It should give you some kind of hint as for what subject I want you to do in your final. All right, thank you for listening to me. Bye.